The doors don't open, they explode. A sonic boom of shouting tears through the corridor, ricocheting off polished stone and metal fixtures. Cameras strobe and machine gun bursts. Then comes the man. Flushed, frantic, fists clenched around mangled documents. Tie dangling, collar soaked. Scott Bessant, Treasury Secretary, doesn't exit the room. He detonates out of it, carving a warpath through a sea of press. He doesn't slow, doesn't blink. Just growls 5 words that hit like a freight train. We sent the letters, 100. That's it. No context, no detail. But Washington hears the subtext instantly. Not letters. Threats. Commands. Missiles in envelopes. Trade renegotiation, U.S. terms only, or you're done. Comply or collapse. No diplomacy, no dialogue, just brute force in bulk. The 1930s called. They want their tariff rates back. Up to 50%, Bessant confirms. A full-scale economic siege. And here's the catch. No one asked for this meeting. Most of these countries didn't even pick up the phone. Sure, a few. Vietnam, Korea, Mexico. They've got skin in the U.S. game. But the rest? Quiet. Calculated. Unmoved. No replies. No panic. Just cold strategic silence, which means only one thing. They either think Trump's bluffing, or they've stopped caring entirely. And that silence? It cuts deeper than any headline. Bloomberg data shows the truth. 63 nations on Bessant's hit list now do more trade with China or India than they do with the U.S. That's not rebellion. That's gravity. They've already realigned. They've moved on. And the chaos? It's not slowing, it's accelerating. Trump pushes the deadline back. First July 7, then August 1st. Now? It's a signal, Bessant says. Not a date, not a line, just a vague, hovering threat. But the market doesn't wait. The second his words hit Bloomberg Terminal, the S&P drops 2.1%. Fast, sharp, like it knows what's coming before the words are even finished. It's not reacting to tariffs. It's reacting to madness, to the unraveling. Because just weeks earlier, Congress passed a $3.4 trillion tax expansion, injecting adrenaline into already overheated inflation. Signals cross, warnings blur. The line between policy and panic disappears. And while the U.S. points fingers, a second front opens like a trapdoor. Trump's latest directive drops a blunt force policy. 10% penalty tariffs on any nation aligning with so-called anti-American BRICS activity. But nobody knows what that means. Is it de-dollarization? Shared infrastructure? Cross-border settlements? No one defines it, which means everyone qualifies. Germany could be hit for trading with China in RMB. Brazil could take double damage just for exploring a reserve asset system that doesn't even exist yet. This isn't strategy. It's targeting by implication. Guilt by association. Trade as a litmus test for loyalty. But the irony? It's thick. The system being weaponized against the world was built by the U.S. itself. The WTO, IMF, SWIFT. Washington designed the map, drew the lines, enforced the rules. Now, as BRICS builds a counterorder, commodity-based, de-dollarized, multipolar, those same lines are being used to cut the U.S. out of the center. The structure that once ensured dominance is now an echo chamber collapsing in reverse. And Bessant calls it leverage. But it's not leverage. It's inertia weaponized. A doctrine without direction. A containment strategy with no walls, no ground, no anchor. Just velocity. Back in 2000, the G7 commanded 70% of global GDP. Today, 43%. BRICS is rising, from 18% to 34%, and still accelerating. IMF data says China will hit 19% of global GDP by 2029. Add Saudi Arabia, Egypt, Indonesia. And if they join by 2026, BRICS could control nearly half the world's productive capacity, and more than half its essential minerals. So again, what power does a tariff letter really carry now? Washington still believes its consumer base is the crown jewel. Irreplaceable, irresistible. But leverage isn't a weapon if everyone can build their own. U.S. importers depend on $3.1 trillion in foreign goods every year. China remains the top supplier. Electronics, batteries, pharmaceuticals, auto components. Even after 5 years of conflict. Bessant's tariffs may sting their exporters, but they'll bleed U.S. producers too. Input costs will spike. Supply chains will splinter. Retaliation won't just happen. It's already happening. In 2024, China BRICS trade hit 4.6 trillion yuan. That's $650 billion, up 5.2% year over year. Despite global recession signals, despite rising rates, despite everything. So what happens when pressure becomes policy? When executive orders force allies to reroute their entire supply chains toward BRICS corridors? Once that pivot begins, it's not a pause. It's a rewrite. And it's not theoretical, it's happened. Since 2023, over 37 countries have formalized RMB settlement channels. The Gulf states have authorized UN crude contracts. Brazil and Argentina now settle 40% plus of their trade with China outside the dollar. That's not a future forecast. That's a rollout. That's a fracture. And the result? Dollar demand slips. U.S. Treasury strength weakens. The reserve bid frays at the edge. And still, Washington digs in, barking orders to a world that no longer has to listen. Because every threat, every letter, every vague red line sent without follow-up, it doesn't project strength. It broadcasts fear, and the world hears it loud and clear. The system is shifting, and the U.S. is still yelling at the traffic, hoping it'll turn back. Let's unpack the shift that's quietly reshaping the global financial order. Over the past year, foreign purchases of U.S. treasuries have plunged by $289 billion, according to Bloomberg. The biggest retreaters? BRICS nations and their close partners. China, once a cornerstone of treasury demand, slashed its holdings by $12 billion, the steepest drawdown since 2016. But this isn't random divestment. It's a structural pivot. As global trade increasingly moves outside the dollar, fewer greenbacks are circulating abroad. And with fewer dollars to recycle, there's less incentive or necessity to buy U.S. government debt. Demand for treasuries drops, yields rise, and the cost of borrowing spikes for Washington. The boomerang effect is already underway. But China isn't simply exiting, it's repositioning. The People's Bank of China has been quietly amassing gold. In June alone, it added 70,000 troy ounces to its reserves. Over the past 8 months, that total has surged to over 34.2 metric tons, based on official disclosures. This isn't about chasing yield, it's about insulating trust. Gold doesn't carry the baggage of U.S. political dysfunction. It doesn't get entangled in sanctions, debt ceilings, or partisan brinkmanship. It sits outside the control of any single nation, and that's exactly what makes it so compelling to the BRICS bloc. The irony is almost poetic. A metal that Washington once stripped of monetary status is now being remonetized by Beijing. The pivot isn't isolated to Asia. Even in the heart of Europe, change is brewing. In a rare and telling move, a German church pension fund, an entity tied to the very institutions that align with NATO, allocated $50 million to a Hong Kong-based China equity fund. Their rationale: exposure to high-growth, undervalued Chinese tech and industrial sectors. But the symbolism runs deeper. This is European capital flowing into a market that Washington increasingly paints as adversarial. While U.S. officials craft tariffs and restrictions, BRICS countries are absorbing Western money. Not loudly, but effectively. And markets are catching on. Year-to-date, the Hang Seng Index has climbed 21.3%. The S&P 500? A more modest 6.7%. It's not a collapse. It's a rebalancing. A realignment. Capital, ever pragmatic, is diversifying. Investors are no longer just looking at returns. They're scanning the system itself. Because when volatility becomes the baseline, yield isn't the prize. Stability is. That's what makes Beijing's next potential move even more provocative. According to Bloomberg, China is now considering a dramatic expansion of its southbound bond connect, a mechanism that could open the gates for up to 1 trillion yuan in outbound capital flow. That's around 140 billion USD, ready to enter foreign debt markets. This would ease long-standing capital controls and empower Chinese institutional investors to buy global assets, Eurobonds, US corporate debt, even treasuries. At first glance, it looks dollar positive, but in function, it's something entirely different. According to sources inside the People's Bank of China, the goal is to foster reciprocal flow, to transform Hong Kong into a mature financial hub that attracts international capital while allowing Chinese money to move outward. It's a bid to build a parallel ecosystem. And for that to succeed, global investors need to see Hong Kong as a legitimate alternative to Wall Street. Already, the Hong Kong Stock Exchange is preparing to list more sovereign BRICS bonds. What's being built is no longer a satellite. It's a self-sufficient platform, one that can scale without U.S. oversight, and eventually compete against it. Meanwhile, Washington's own policies may be accelerating the fragmentation. Trump's latest tax package, according to the Congressional Budget Office, will balloon the deficit by $3.4 trillion. Inflation projections have already jumped by 1.7 percentage points for 2026, but the deeper impact may be political. The Joint Committee on Taxation reveals a troubling asymmetry. The top 20% of earners are projected to gain 2.3% in annual income. The bottom 20%? They lose exactly 2.3%. In other words, the rich get richer as the working class foots the bill. Combine that with rising tariffs, feeding directly into consumer prices, and you get a perfect storm. Purchasing power collapses at the bottom just as the wealthy redirect assets overseas. The middle class, squeezed from both ends, stops spending. And when the middle stops consuming, the machine grinds down. Growth slows. Retail stagnates. Small business investment contracts. This isn't speculative theory, it's historical déjà vu. It's the 1970s inflation spiral, only turbocharged and globalized. The Peterson Institute warns of 15 to 20% inflation if August's proposed tariffs take full effect. That's not just economic pressure, it's political risk. It's civil stress. And yet, on the other side of this divide, BRICS economies are playing a different game. They're cutting rates, expanding credit, boosting trade incentives. The contrast couldn't be sharper. As the US tightens, BRICS accommodates. As Washington talks decoupling, BRICS talks integration. It's not just a divergence, it's a philosophical split. One side is retreating into protectionism. The other is quietly building new bridges. But perhaps the most bitter irony of all? The very system BRICS is using to challenge US dominance was built with American tools. Global trade infrastructure, digital payments architecture, dollar-denominated supply chains, even the blueprint for multilateral development banks. All exported by the West, now repurposed to dilute its influence. This isn't a revolution. It's a remix. The old trade world isn't being overthrown. It's being re-engineered. And if the US responds with threats rather than competition, if its strategy defaults to coercion instead of innovation, it may not be tariffs or capital controls that isolate it. It'll be gravity, the natural pull of capital, looking for function, not flags, the quiet drift of trust away from the center. So the questions now are urgent and unresolved. Will BRICS pull back or push further? Will Trump recalibrate or double down? Or are we simply witnessing the final fracture of the post-war global trade consensus? The pieces are moving. The story is already unfolding.